Hello everyone, my name is Helena Ising. My metric number is BB3040361. As we can see here, there are two types of markets, which are spot market and forward market. Both of the markets play a crucial role to deal with any transaction in currencies. Here, the spot market refers to a transaction in which one currency is exchanged for another currency based on a fixed exchange rate. In spot market, buyers and sellers physically exchange items which prices reflect the current supply and demand condition. The subspot of spot market are forward cross exchange rates, triangular arbitrage, and spot foreign exchange markets. Here, we can see the advantages of spot market, which include spot prices are generally more transparent as all transactions and prices are available to the public. Then, participants in the spot market are exposed to immediate market risks such as price volatility. However, the spot market has several disadvantages, which include the spot market are highly liquid, meaning that market participants can enter and exit position with minimum price impacts. Then, the volatility can change rapidly without warning since the price is determined by current market conditions. We move to the forward market. So the forward market trade contracts determine a current price for commodity transaction designated to occur later, where the prices depends on interest rates as the prices will be applied over the period from the transaction date to the settlement date of the contract. Then, the subspot in this forward market, which are forward cross exchange rates, forward premiums, and exchange traded currency funds. The advantages of forward market includes hedging risk management. Here, the forward market allows businesses to protect themselves against the fluctuation in foreign currency rates. After that, the forward market is considered can be customized to meet the specific needs of the parties involved. However, the forward market disadvantages, which include it is not flexible and liquid, which means that buyers can cancel or change. Then, the forward market in terms of contract, they are not transparent and standardized, meaning that you may not know the fair value or the market price of the contract. That is all for me. Thank you.
Cross-exchange rate quotations refer to a transaction that involves the exchange of currency between two types of foreign currency. Then the two pairs of currency are evaluated and compared with the third currency, which always have a strong value in the foreign currency market. The USD dollar is a currency that is usually used to compare and determine the volatility of the local currency. Cross-exchange rate quotation can be categorized into two types of components, which are direct quotation and indirect quotations. Direct quotations mean the cost of one unit of foreign currency is given in a unit of local currency, while indirect quotation emphasizes situation where the cost of one unit of local currency is given in one unit of foreign currency. These example calculations for direct and indirect quotations. For direct quotations, we use 1 USD equal to 1.21357 renminbi divided with 1 USD equal to 0.91887 euro. We divide both exchange and we get the final answer 0.12743 euro per renminbi. For indirect quotation calculation, 1 RMB equal to 0.13 and 1 euro equal to 1.088 USD, and plug in into the formula and calculate it until we got the final answer, which is 0.12743 euro per RMB. Both methods come out with the same result, indicating that 1 RMB is equivalent to 0.12743 euro, which means that either direct or indirect quotation both are consistent. Triangular average is a type of transaction system that produces a profit as a result of discrepancies between three types of currency when the exchange rate across the currency market do not match. Profit can be seen when the currency exchange rate does not match the cross exchange rate. It is considered a price discrepancy where the conditions of market is evaluated differently from the value of another market. Triangular aggregate is categorized as one of the spot market components, since it entails the immediate purchase and sale of currency at current market rate with immediate delivery. Looking through example, assume that one investor start the capital with 2000 USD. Time the capital with the value of conversions from USD to Euro, and we get 1837.77 per Euro. Then we convert Euro to Renminbi, and we get, and time with the answer that we got in step 1, we got 14,430.29 Renminbi. Then we convert Renminbi to USD, time with 14,430.29 Renminbi, we get 2001.48 USD. Then we use the value and minus the capital, and we got around 1.48 USD. Therefore, the execution of triangular aggregate with the beginning of 2000 USD as capital have grown by 1.48 USD profit without risk. This shows that aggregate opportunities still exist even though the profit margin is low.
My name is Sankyu, metric number BB211105545. Today I will present the spot market foreign exchange microstructure. So the spot market exchange rate is a key part of the global financial system, offering high liquidity and continuous trading opportunities around the globe, except on weekend. This market, also known as Forex or FX, that operates as a global over-the-counter OTC market. So the participant in this market includes banks, central bank companies, hedge funds, and individual investor or individual trader. So they trade currency pair where the value of the currency is relative to another, facilitating international trades and investment. So the trades is influenced by traditional macro exchange rates theory combined with the microstructure model, which help investors speculate on the market direction. So currency exchange rates are mainly determined by market force, though there are some fixed floating rates are set by the governments. So in the FX market, various currency from the country around the world are traded. The constantly fluctuating currency value presents opportunity for traders to generate profit, though this comes with a high risk. The key method used to determine currency value difference includes the exchange rate and bid-ask spread. The exchange rate is the value at which one currency can be exchanged for another. This rate is influenced by market supply and demand and fluctuate due to the economic factor. For example, an amount of USD needed to buy one Canadian can vary and is tied to the financial dilemma of capital, which is the capital mobility, affect exchange rate, and monetary autonomy. So for this formula, market exchange rate equals to base currency divided with the quoted currency. So next, the bid-ask spread is the cost of making transaction in the currency exchange market. The gap of price difference between the bid price and the ask price is a transaction cost at that time. So trader pay the ask price when buying and receive the bid price when selling. So incurring the spread is as a transaction cost. So from according to Ganti, that said the bid-ask spreads function as an indicator of the liquidity of the currency exchange market. So mean the smaller spreads is more liquidity than the larger spread. So to determine the spreads is the formula spreads equal to ask price we minus with the bid price. Type of order. In FX market, there will be a fill order and executed order that will proceed by a broker based on the order placed by individual trader or companies. There are two types of order that are often done in the market. First is market order, second is limit order. Market order. Market order is instructed by broker to buy or sell asset at the best market price, which is a facilitate easy and quick order placement based on the current market condition. And limit order is allow trader to set a specific price which they want to buy or sell. So these provide control over the price at which the trader order will be executed at that time. Yeah, thank you. That's all for me.
Good morning to Dr. Wong. My name is Punifat, and I'm going to present the forward exchange rate. It refers to an individual who enters a contract that agrees to exchange a currency for one another at a predetermined price in the future. It is determined by three types of operation. First, hedging, which refers to a strategy of an individual to protect itself against the risk of exchange rate fluctuation when exchanging a currency for one another in a financial market. let's say there's a company in Malaysia that wants to import items from US and it expects that the price of US dollar will appreciate against ringgit Malaysia in the future. Then the company A will enter a forward contract to lock into an exchange rate of 4 ringgit per US dollar. So when exchange rate appreciate to 4.1 ringgit, then it can gain the profit of 0.1 ringgit Malaysia in the forward contract. Furthermore, the forward exchange rate is also determined by speculation. A speculator holds a firm perspective on future movement in the foreign exchange markets and takes an uncovered position in a particular currency in order to profit from a shift in exchange rate. For example, the speculator may attempt to purchase currency A if he thinks that currency B will depreciate in the future. He will enter a forward contract to sell currency B and buy currency A at a predetermined exchange rate in a future date. If currency really depreciates in the future, then the speculator will benefit from the fluctuation in exchange rate when the contract matures at a given time. Moreover, the forward exchange rate also can be determined by cover interest rate arbitrage. When the spot and forward exchange rate are not in equilibrium stated by interest rate parity, the cover interest arbitrage offers the possibility of making profit without taking any risks. An arbitrager will borrow money in a country at a lower interest rate and convert it into foreign currency with higher interest rate to invest in another country. After that, he will enter a forward contract to hedge against the exchange rate risk in the foreign exchange market. Once he earns profit from the investment, he will repay the money that he borrows and the interest charged on the loan. The remaining money after paying the loan will be the riskless profit that the arbitrager could probably earn. That's all from me. Thank you.
Hi, my name is Olivera Jessie Doimi, matrix number BB211106665, and today I'm going to present about the forward premium. The forward premium in forward market is known as a key concept that reflects the relationship between the spot exchange rate and the forward exchange rate. The forward premium is calculated as the percentage difference between the forward exchange rate and the spot exchange rate. When the forward exchange rate is higher than the spot exchange rate, it is known as a forward premium. The forward premium can be a signal of market expectation regarding the future exchange rate movements, which may have an impact on how investors and businesses make decisions. In addition, forward premium can be influenced by many factors, such as interest rate differential between the two countries and market expectation. Firstly, the difference in interest rate between two countries can influence the forward premium. In other words, a country's forward price for its currency would be higher than the spot price, and if its interest rate in one country is higher than in another, it indicates a higher cost of borrowing in the currency. Another important factor that can influence the forward premium is market expectation regarding future exchange rate movements. If investors expect a currency to appreciate in the future, they may be willing to pay a premium for the currency in the forward market. Moreover, the forward premium has implications for both individuals and businesses involved in the international transactions. For individuals, the forward premium can impact the cost of purchasing goods or services denominated in a foreign currency, as they may need to pay a premium to lock in the exchange rate in advance. For businesses, the forward premium can affect the profitability of international trade and investment, as they may need to account for the potential fluctuation in exchange rates when making decisions. To conclude, the concept of forward premium in the forward market for foreign exchange is a complex yet significant component of global finance that reflects a market expectation interest rate differential and has direct implication for individuals and businesses. That's all from me. Thank you.
Hello, my name is Elvina Hani Elima with metric number BB21110197, and I will be presenting about exchange traded currency funds, which is ETFs, are passively managed ETFs that provide investors with exposure to overseas currencies, particularly the forex market. These funds offer strategic exposure to foreign exchange market through a portfolio of currencies, reducing risk. ETF manager use various investment strategies, including cash deposits, short-term bonds, and overseas derivative contracts. Despite their safety, ETFs carry the highest level of risk. ETFs use forward contract to gain exposure to underlying currencies, minimizing the need for spot positions. Rapid growth in ETFs globally suggests the need for close monitoring for financial stability and regulatory implications, including potential interactions with other financial systems. ETFs provide FX exposure but face liquidity risk, posing financial stability risk. Disruption can lead to redemption pressure and knock-on effects on related markets. Liquidity transformation is crucial but subject to friction. Market makers' high-frequency strategies raise operational risk. Lastly is the European Central Bank, which is ECB, has called for new rules to increase fund liquidity buffers and align redemption terms with underlying asset liquidity. The European Securities and Markets Authority, ESMA, warned investment funds with less liquid assets to prepare better for market shocks. ESMA set 5 priority areas for fund managers and regulators, including ongoing supervision of investment strategy alignment, liquidity profile, risk assessment, and valuation processes. And that's all from me. Thank you for listening.
To sum up, spot market and forward market are very complex and have diverse investment with a few types of sub-spot for each market. For example, cross-exchange rate quotation, triangular arbitrage, and others. So each market serves specific purposes and plays a crucial role in the economy. Both of the markets are integral parts of foreign exchange markets. So by understanding the differences between these markets, participants can actively manage their currency exposure and capitalize on opportunities in the market. That is the end of the presentation. Thank you.